Good morning, ladies and gentlemen. I don't have any particular words of wisdom at the moment because we only had 3 trading days last week, but I wanted to show you what I'm looking at so that we are prepared for next week. The most important anticipated event is Powell's speech at the Brookings Institute, where he's going to answer some questions. That's on Wednesday at 1:30. He's going to talk about monetary policy, and he's going to answer questions. So potentially that is going to be a price moving event. So let me tell you what I'm looking at ahead of that, and I think that where prices end up on Wednesday is going to be important. Now, this is the 2-year note, and let's have a look at this day here. This day here was CPI. And to me, it's important that the market stays below where we were when CPI came out. And as you can see, that is 456. So mark that, have it, have that level in mind. 456 to me in the 2-year note is very important, and I'll show you through the yield curve why I think that is important. As long as twos stay below 456, I think the market is still in a downtrend in terms of yields and an uptrend in terms of price in general throughout the bond curve. If we have a look at what the other 10-years did, let's have a look at the fives. This is CPI. You can see that the fives have remained well below those levels in CPI, and to me the most important level is right here, basically 407. As long as we remain below 407, we should be headed towards 370, 371. If we have a look at the tens, basically you can see that the longer out in the curve we go, the more the curve inverts, the more the prices are positive since the CPI date, basically telling you that CPI was important. And here we can actually put in a, right there, we can just basically say that as long as prices stay below that level, we are still positive, and we are headed towards something like these levels, 350. I very much doubt that Powell is going to say anything fantastic, but you can see what the curve is doing. If we now look at 30s, this is CPI, and you can see that basically the markets decided that longer term CPI was a very, very important event, and since CPI they've been doing more or less nothing in twos, but buying everything further out, and the further out you go, the more they're buying it. To me, this level here in 30s is going to be very, very important. 360, I very much doubt that we can break through 360 ahead of Powell, and even after Powell, I find it difficult to believe that we can do that. So what is the curve doing? Basically, whatever you look at, twos, threes, still in an uptrend. Twos, fives, still in an uptrend. And if you remember, there's that Fritz guy who is at Citibank, who is looking for twos, fives to go, because if you change that to a monthly, you can see that basically we've gone through all the levels in twos, fives, and he's looking around -70. Does that make sense? Yes, it does. How do we get to -70? Well, basically the twos do nothing and the fives do better. So that is, the curve is definitely still flattening. And while twos, fives are doing this, it's unreasonable to expect that the other 10 years won't flatten as well. So if we look at twos, tens, still flattening, still through the best levels that we've seen basically since the early 80s. And probably getting very close to the levels even at the Volcker massacre. So as you can see, the bond market has very much decided. If just by looking at these prices and the yield curve, the bond market has very much decided that recession at some stage hits. Now, what happens when recession hits? It's very unlikely that the tens in this case, because this is twos, tens, right, are going to do worse. What happens is that twos just fall out of bed. They go percentage points. So what happened here? Well, it wasn't that the tens did nothing, the tens did better, but the twos did much, much better than the tens. And that is always the way, because what the market anticipates is that the Fed is going to have to cut rates, and not by a little, but by a lot, in order to save the economy from the recession. So that is why I keep on saying be very careful with the short end, because when the short end starts moving, it's going to move a lot. So now let's have a look at twos 30s on top of that, and here you have twos 30s basically at the at the highs. That is all that can be said about it. And if we look at the very significant 5s 30s and we turn that to a daily, basically 5s 30s are holding on to this 11 level. They're not going very far away. Can they get to 20? Can they get to 22? Yes, they probably can, but I would have thought that when recession is not going to strike in 2026. And the market just can't predict that. If recession is going to strike and this yield curve is correct, and let's face it, the yield curve is nearly always correct, it has to strike next year, or at the very worst, it has to strike late next year, or Q1 2024. But we're talking about 1-2 quarters left or right. That I don't think is going to be all that significant. It might be significant for where we start the descent, but it's not going to be significant for the descent. And all these charts to me are doing some kind of a very long-term head and shoulders. Where the exact right shoulder is going to be, who the hell knows, but they all seem to be doing much the same thing. To me, it's only a question of when this recession strikes as opposed to if. As to the timing of when this recession will strike, well, the market is saying we're nowhere near. I want you to have that in the back of your mind, because the twos and the fives are really only going to do significantly better than we see them at the moment, and the volatility of them is going to be significantly higher, i.e. to the downside in terms of yield and the upside in terms of price, only when we get indicators, i.e. real economic numbers that say the recession is upon us. And then you would expect these charts to actually start turning downwards. This is SPY over SHY, which is the 1 to 3 year ETF. So the very short end of the bond market. Does this look bearish to you? Not especially, right? And don't forget, this is a weekly chart. So if this weekly chart is in an uptrend at the moment, that means that SPY is outperforming SHY. And as you can see, when the fear of recession or recession strikes, this is SPY over SHY back COVID. And if we go back a long time more, we go to a monthly chart. This is it in 2007, down all the way down to 2009, and then the uptrend starts. So you can see that, whether you look on a monthly basis or you look on a weekly basis, this chart is now doing this. So this is saying quite a few months to go, potentially before we can have a significant fall. And the fall, I would have thought, would go down at least to these levels. So you're looking for, new lows in the SPYs without any problem at all, and new highs in SHY kind of thing. I mean, just a complete debacle. Same pattern if you have a look at SPY IEF, which is the call it the 7-year. This is not particularly bearish, right? And this is a monthly chart, and basically all we've done throughout 2022 is go sideways. We haven't given up anything at all, and if anything, this looks still bullish. So saying that SPY is going to outperform the 10-year sector, well, if that is happening and the Fed wants the economy to slow down, how far can the 10-year go down in yield, right? It's not going to happen. SPY TLT is a 17-year duration, and this is a monthly chart, and it's still going up. So basically all these charts are saying recession is not likely to happen at any time soon. The earliest I can see it is late Q1, early Q2, but most probably it's going to be Q3, Q4 of next year. So this is what these charts are saying. And while these charts are saying this, it's very unreasonable to expect any tenure in the bonds to do much better. The yield curve can keep on going flatter, i.e. more negative, but the twos certainly aren't going to go very far until they get data, and the yield curve can only go that far negative. I mean, we saw in the 2s, 5s that you can go another 20 basis points, and let's say that those 20 basis points come entirely from the 5s, and we can have a look at that and go like this and say those 20 basis points come entirely from the 5s. Well, what are you looking for? You're looking for 370 in the 5s, maybe 366, and then they go back up, right? So even if we turn that to a weekly, what are we looking for? We're looking for this kind of level, 365-ish, and then back up to 410. That is the environment that we're in. Don't get very excited either way until and unless economic data strikes. Okay, now let's have a look at Germany. This is the 2-year note daily chart, as you can see. Does this look like it's ready to turn over? No. The Schatz basically is screwed. It's just too expensive. If we have a look at it on a weekly basis, does that look like a market that wants to come down? No, not to me. To me, the best you can see is around this 192 level, which is somewhere around whatever that is, 107, sorry, 102.25, let's call it, in terms of December shats. To me, anywhere near that, it's a short. We're still going up. Even if we have a look at the best case scenario on a monthly chart, we're doing something like this. We're just going to go sideways and slowly get to 268. I mean, let's face it, the ECB is way behind the curve. They've told us innumerable times now that they're going to keep on tightening. And therefore, why should the twos do better? I mean, you can argue lack of collateral, you can argue this, you can argue that, but all that is an argument that it doesn't go much further than 268, rather than it's an argument that it comes down. To me, the twos here are, the safest short you're going to have for a long time. If you have a look at the fives, and let's go back to a daily chart, as you can see, they're just doing nothing. They're just going sideways, up and down. And the tens are the ones that are, the most bullish. They're trying to keep up with the US. This chart to me was significant when we broke down, because it's basically telling me that there is demand. And this to me, it says that Europe will try and keep pace with the with a downtrend in the longer tenures in the US. But basically what I'm expecting is just a retracement. This is the 50% retracement. So I'm basically looking for 217, and I'm not going to short it till 217. And that is all that there is. That really tells me that there is demand. But all these charts longer term are doing, head and shoulder patterns. And even the 30-year in Germany, to me, this is much more likely to now start going sideways rather than being bullish. And that's why I'm not particularly bullish for the US. I'm bullish for maybe 10 basis points. But basically what it's saying, it's a trading market. The differential charts between the US and Germany are looking interesting to me. I mean, if this is not some kind of a long-term head and shoulders, I definitely hope it is. It just shows you every time these are twos. So every time we go up to that 255 level, it's a mega sell. And I think we are far more likely to trade 210, 215 than we are to exceed 255, or to even trade much above 240. So it just shows you at the moment that the US is, how can you justify it? Let's go from first principles. The US has basically it has reached, or has anticipated, or has discounted, that's a better word, its terminal rate, while Europe hasn't yet, or to some degree it hasn't, to a greater degree than the US. So that is what these charts are telling me in the twos, even the fives. You can see how the fives are reaching the worst levels of the year. Basically, this is where we started 2022, and we are only, less than 10 basis points better. Think about it, that is pretty important. We've had everything that's happened this year in the bond market, and this differential is not even 10 basis points different. That to me says this market eventually breaks down. And this is the tens. It just cannot hold these 190s. Every time it gets up there, it's a great sell. I'm convinced that at some stage it breaks 152. But let's have a look where we started the year. We started the year here. So tens are at exactly the same level as we were at the beginning of the year. And think about what's happened in the US. Is that not significant? Have a look at 30s. Where did we start the year? We started the year right here. And I think 30s is also going to break down. If we have a look at a monthly chart, you know, it just cannot hold anywhere above 2, which tells me that some stage we trade down to 160 again. So really, it just tells you that this is not going to be any kind of a bull market in bonds for quite some time. It's going to be a sideways market, and where technical levels are very, very important. So if you just scroll back here, you know, to the beginning when I showed you the US yield curve, and you look at the levels that I've marked, to me, this kind of level in the 30s is not going to get from 360 to 345. No way does that get broken. We are far more likely then to trade back up to 4 than we are to break down from it. What these charts and the spreads are saying to me, basically to recap, is that the recession is not upon us yet. It will be one day, because that's what the yield curve is saying, but it's not upon us yet. We could go sideways for quite some time, and in this period where we have positive seasonality in equities, there really is no point in getting short of equities at the moment. That's not what the bond market is saying, and that's not what the yield curve is saying. They're not saying get short equities now. They're saying equities will fall out of bed at some stage next year, but God knows how high they can go in the meantime. And just a very quick word about equities, since Powell will be speaking on the last day of the month. It's going to be potentially very important where we close this month. You can see that this is a monthly chart. These are the monthly candles, and it'll close on Wednesday just as he speaks. If we close above where we are now, I can, I'll bet my bottom dollar that we will trade 41.81 the first few days of December. So without any doubt, I think 41.81 will trade, and then that will be important where we close, because if we can't come back or significantly retrace, we are talking about a market which potentially will be touching these levels again, i.e. over 4,200, possibly even 4,300, that kind of thing. Why not? It basically what all the spreads are saying is that it's going to happen later, i.e. the recession is going to happen later rather than sooner, and the market can get stupidly bullsed up for no reason and then fall out of bed. Get everybody who's short here, get them all long, and then fall out of bed. Makes sense to me. If we have a look at a weekly chart, and sorry, let me just try and find the weekly chart, but here you have the daily chart. I mean, once touching the 200-day moving average and backing off, okay, I can take it, but twice, I really don't think so. And as you can see, really, you don't have much resistance until you get to these levels, the 4200s, and you have a great big hole here to fill all the way up to whatever that is, 4216, 42, just above 4200. I would much rather bet that we do something like that and then come off, rather than touch the 200-day moving average and then fall out of bed. I think that is unlikely. It's just not going to happen. And here's the weekly. Okay, so to me, very, very little doubt that we go to these levels, 41.64, 42.47. I just can't be short of equities. I just can't short them. I see no reason to short them at the moment. I think everybody needs to get long and bullish, and then the economy can fall out of bed. It's not going to fall out of bed until we see these levels, I don't think. That's all I've got to say. I see absolutely no reason to be short of equities at the moment, not until we get some data. And if that is the case, it's unlikely that bond markets will do much better. So everything that I've shown you actually fits together and has a cohesive story to it.